Good day, everybody. Let's get started. There's lots of people to join, but in the interest of time, let's crack on. There's a lot of interesting content to get through. So, welcome everybody. My name is Emmett, Kilduff. I'm the CEO of the Fortia Group and your chairperson today for the discussion. So today's topic is demystifying LOIs, demystifying letters of intent. In terms of the agenda, there'll be 2 to 3 minutes from me just updating on some of the items the Fortia Group is working on. I'll then ask each of our 7 speakers today to give brief introductions to themselves. We have 2 law firms and we have 5 legal counsels from Aggregators. So we have a great collection of speakers. When we had our panel preparation call, we decided to boil down the LOI into sort of 5 key topic areas, and we're going to spend approximately 7 minutes on each of those, going into a lot of detail to help you, the Amazon brand owners, really understand LOIs, so that when you get to negotiation stages, you're armed with a good understanding of how it all works and what are the key points. And we hope to have at least 10 to 15 minutes for Q&A. For that, please do submit your questions via the Q&A button. Great to see there's already one there. Please do not submit it via the chat. It's much more difficult for us to manage and field the questions. A copy of this deck and the recording will be made available to you via the Fortia Group website in the coming days. So let's jump in. Just briefly from the Fortia Group, we have been doing monthly webinars for several months now. All of the recordings and materials are available via our website, thefortiagroup.com. Last month, we put on a big showpiece. We had 10 entrepreneurs that have sold their businesses to Aggregators discuss their stories, their experiences of the deals and how the deals have been faring post-acquisition, which is just as important as the deal itself, given earnouts are a big component of compensation. At the start of the year, we had a webinar on timing. Clearly, with stock markets have come an awful lot since then. So the timing for this year, the timing for selling is good at the moment. And back in December, we had a webinar about how to increase your valuation as people looked ahead to this year. So if any of those are interest, please do log on to our website and enjoy that content. So at Prosper a few weeks ago, we announced 2 new pillars of our offering. So there's 3 pillars now. The first pillar is the core part of our business, which is advising e-commerce entrepreneurs on their exits and bringing quality deal flow to buyers, aggregators, PE firms, and so on. The 2 announcements were, one, we have started to advise aggregators themselves on their corporate finance needs, whether that's equity financing, credit financing, M&A, sell side or buy side. And I have the ability to bring in my former colleagues at Credit Suisse, bulge bracket investment bank, to help advise aggregators. So between a boutique like Fortia that understands the space and a bulge bracket like Credit Suisse, we have a good potential team to bring to the table. And then finally, really excited about launching a syndicate to invest in new or niche aggregators. I'm actually here in the French Alps with the investment syndicate to help with the launch of it. We are curating interesting new aggregators, such as one focused on the beauty category, one focused on distressed DTC Shopify brands, one focused on China, and all of those are being put in front of the investors of our syndicate in the coming weeks. If that's of interest, please reach out to me direct, and we can discuss. This week we started a newsletter. There's so much going on in this space. We're seeing so much happening. We thought it'd be helpful to publish a wrap of everything we're seeing across the month that's relevant for both sellers and buyers. So if you'd like to sign up for that, please do so via the homepage of thefortiagroup.com. Looking ahead, we have these types of webinars every month. The next one will be on the 21st of April. There's 3 other events we're working on. The first is on Tuesday, we'll have a roundtable dinner for aggregators in New York. We did this in London and Berlin back in November, worked really well. It's a dinner discussion. It's not just eating and drinking. It's a debate with an agenda. And if you'd like to attend that, please reach out. On the 6th of April, we'll have the first of a quarterly virtual a discussion for M&A professionals at Aggregators. And if you'd like to attend that, please do let me know. And then finally, in early June, we're going to host, I think, what's going to be the world's first large conference specifically for the C-suite of Aggregators, and that'll be in New York. So again, if that's of interest, please give me a heads up. Okay, so let's move on to introducing the speakers. So we'll go from left to right, and this looks like a boxing match. That was really just for marketing purposes, where there's no winner and loser in terms of LOI negotiations. In fact, what we really want is a win-win for both sides. That's the best deals are win-win for the buyer and the seller. But we wanted to have two law firms representing the sellers, and we have a super collection of legal counsels representing the buyers. So without further ado, Nathan, please introduce yourself. You might be on mute, Nathan.
Thanks, Emmett. Yeah, looking forward to being part of the conversation. Hi, everybody. My name's Nathan Lapsley. I'm a corporate lawyer at 458 Law. My background is in M&A and supporting clients with various of the corporate transactions in the UK. Since 2019, my focus has been on helping sellers and aggregators with their exits, their acquisitions and their financings. And that's the team's main focus at 458.
Thank you, Nathan. Chris?
Thanks, Emmett. Hello, everybody. My name is Christopher Carroll with Revision Legal. Revision's a law firm that specializes primarily in helping people who make money online through their whatever legal needs, whether it's corporate or more transactional and deal side. My focus is on the deal side. I've represented a variety of sellers and buyers and funds, but for the purposes of this conversation, I'll be focusing on the seller side of things. Prior to joining up with Revision, my background was in corporate counsel. I spent about a decade as legal in-house counsel for a variety of different entrepreneurs in several different business fields, including e-commerce and B2C and B2B .coms.
Thank you, Chris. So representing the buyers, we start with Andrew, please.
Hello, everyone. Pleasure to be here today. My name is Andrew Goldman. I head up the legal team at Acquco. Just about a year ago, I would have been on the other side of this slide. My background comes from working at a law firm in New York named Paul Weiss. While I was there, I was representing buyers and sellers, primarily on M&A transactions in a bunch of different industries. Really looking forward to the discussion and hopefully getting some people to reach out to Acquco.
Thank you, Andrew. Sean?
Thanks, Emmett. Hey, everyone. I'm Sean Foley, Associate General Counsel, leading up the acquisition and strategic investments work streams here at Branded. Background prior to joining Branded was at a New York law firm, Debevoise and Plimpton, in that M&A group, and a variety of corporate transactions, M&A, kind of acquisitions, equity financings, and corporate matters generally. And looking forward to a robust debate.
Thank you, Sean. Philipp?
Thanks. Pleasure to be around today and looking forward to be part of the panelist team. My name is Philipp Lehnen. I'm 36 years old, Senior VP M&A with Stryze Group. Stryze Group is one of the leading direct-to-consumer brand houses in Berlin, building, developing, and acquiring D2C brands, currently focusing very much on Amazon FBA businesses. But generally, we are actually quite flexible in terms of acquiring targets in the broader D2C space. We actually started out as an Amazon FBA seller ourselves, so we really know what we're talking about, bringing the operational expertise to the table, knowing how to grow brands internationally, in particular in Europe and US. I personally have more than 10 years of M&A experience in different settings, including investment banking, private equity, and various corporates. As I said, looking forward to being here tonight.
Thank you, Philipp. Richard?
Hi, well, thanks very much. Delighted to be part of the panel. Thanks for having me. My name is Richard Cohen. I'm Vice President of Operations and General Counsel at Unybrands. I started off life as a finance lawyer at Allen & Overy, which is one of the large international firms, and then sort of gravitated into tech and was particularly interested in how you can automate a lot of the processes around transaction execution, which I did initially in the capital market space and then came to unybrands. Have a wide range of responsibilities here, but of course look after a lot of the execution of the M&A piece and trying to make those the transactions of the execution of those transactions as seamless and efficient for all of us as possible.
Very good. Thank you, Richard. Wolfgang?
Yeah, thanks, Emmett. Also very delighted to be part of the panel. My name is Wolfgang. I'm since 2019 with Unybrands Group as general counsel. BBG, as we call it, is a global e-commerce company and one of the pioneers in the D2C business. We sell more than 4,800 products under currently 56 brands and over 100 channels in 28 countries, mainly from our passions, household living, gardening, outdoor, sport and fitness, and as well as sound and light. We have been recently valued with $1 billion, acquired 42 brands since the end of 2020. Yeah, briefly about myself, look back on a nearly 20-year career as legal advisor in private equity, venture capital, M&A transaction, mainly in industries like stationery, healthcare, civil engineering, semiconductors, and aviation.
That's great. Thank you, Wolfgang. Okay, so we have a super lineup today. Let's get into the meat of it. So we have 5 key topics. We're roughly going to spend 7 minutes on each of these topics. For each topic, there'll be Chris and Nathan giving the views of the seller, and Richard or someone from an aggregator giving the views of the buyer. There will be some overlap, but I think it'll be interesting to the viewers. So can I start with Chris and Nathan to give views from the seller side, please?
Sure. Yeah, I'll hop in here real quick, Nathan. I mean, key goals of the letter of intent obviously are just trying to hammer out some of those material deal terms at the forefront. The way that I usually approach it is advising the sellers to make sure that, if they have any particularly concerning issues, besides just, the payment terms and the structure and how that's going to go, now is a good time to really kind of get in front of that. Better to have those harder conversations early on in this process, in case there's maybe some roadblocks, and you can sort it out before you start wasting too much time and effort past this this stage. Beyond that, on the seller side, the other thing that I always say too is they're often presented with the LOIs from the buyer, but it's a collaborative process, so they shouldn't feel as if this is a take it or leave it situation. They do have input in kind of what goes into this ultimately at the end of the day.
Thank you, Chris. Nathan?
Yeah, echo Chris's comments there. Main focus for lots of vendors is primarily about the economic terms and just making sure that the commercial agreements outlined in the LOI. Other than that, just to piggyback on what Chris said, you often get a seller that has something that's very specific to them, whether it's because they have another brand in the same vertical, or they work in an industry which may cut across the brand that they're selling, which something like that would just need to be discussed, agreed, and papered in the LOI as well. And often people have other businesses which need to be carved out of a particular legal entity, or they're staying on in a more formal role with the aggregator where the terms of that engagement and that employment are quite sensitive, and they actually want agreement on those at LOI stage. So yeah, just put it into 2 buckets in terms of economic terms, and then sort of fundamental terms which are really, really critical to a seller.
Great. Thank you, Nathan. Richard?
Yeah, thanks very much. So I think, from the buyer side, probably those first 2 bullet points that are the key elements. It's to agree the main commercial terms of the deal. And now that's obviously the structure of the transaction in terms of, is it going to be an asset purchase? Is it going to be a share purchase, etc.? And then, of course, the payment terms. I won't spend too much time on that because we've got a number of slides on it. But I realize that's the line that everyone looks to. And of course, the other key point is to get exclusivity in place with the seller so that you've both got, the space in which to do the diligence and to do the deal, and in which, that once you're making an investment in that deal, the seller is only going to be speaking to you and not going out to other parties. That's obviously very important to us. And then I think that the next sort of points flow from that once you've got your kind of framework and main commercial terms in place. Obviously, there's an element to the LOI which is us wanting to also give, you know, the seller good comfort, you know, written down as to why we're going to be a great partner and why we're the right people to buy your business. Obviously, you know, by the time you come to sign an LOI, you will have met us. You will have, you know, we'll have probably a number of seller calls. So you will have some comfort through that. But we also think it's helpful that, you know, people understand where we're coming from, what our background is, and so you've got comfort to contract with us. We also, of course, want to set out the process and the framework for the execution of the transaction in the LOI. So once you've moved on from the pricing line, we'll have sections on diligence and documents and what the process is around that. And those are really important because they do set a framework for how we're gonna execute. And I think probably, you know, what I would say to any sellers that are thinking of selling their business is, you know, it would be super helpful, and you will get an awful lot out of it if you invest in being sort of transaction ready, so that when you come to do the transaction and you sign up to these processes, you're able to sort of follow through, because that's when the issues in diligence come down the track, right? Things like not having accounts in order, or not having your IP properly protected, or saying you sort of comply with regulations and terms of service, but us in diligence finding out that there are issues there. So, you know, I'd say to people thinking of selling a business, best investment you can make is get an accountant and a lawyer early to go through all this stuff, so that when you come to sign the LOI, you're confident you can deliver on that process. And then I think we had a question already in the Q&A around what legal protections we're looking for. Those 3 bullet points really cover that. I suppose the key point to make is that, you know, most of the LOI is not legally binding, but of course, you know, from a commercial perspective and reputationally, you know, it's really important that both parties stick to it. Obviously, not every deal makes it through diligence, so not every LOI you sign comes to fruition. But it should be the case that when you sign the LOI, and certainly it's the case of unybrands, that we will never sign an LOI that we do not, at the time of signing it, fully expect to execute on the transaction. But most of it is non-binding, so most of it is kind of a commercial protection and a reputational one, but there are a few points you look for legal protection on. One is the covenant not to compete, and, you know, making sure that you're protected there. Obviously confidentiality, and I've mentioned the exclusivity bit at the beginning, but there's a sort of formal legal protection around that as well. And those are kind of the 3 points I draw out as ones that we look to have kind of formal legal protection on. But as I say, you know, it's the commercial and reputation point that binds people to it more than the law, I think.
I think that's been really helpful to sort of set the scene for the LOIs. Maybe a quick question to you, Richard, is clearly not all LOIs turn into completed deals. What are some of the, you know, the justifiable reasons for, you know, completing on an LOI, and maybe talk on behalf of the industry, not necessarily you know, your unybrands?
Yeah. So look, I mean, you generally, you know, you'll never have a diligent process that doesn't yield issues, right? You will always find something, right? And, you know, sometimes it's just good to be aware of those. Sometimes they rise to the level of, you know, you needing to structure around them, whether that's something you put in the legal docs as a protection. Sometimes it might be, you know, you've got to alter the payment terms. Sometimes it might even be lower price if, you know, give an example, you know, you're presented with something you're told is great, and it turns out there's no IP or brand protection in one of the key markets you want to expand into. I think really, you know, generally you won't find stuff in diligence, or you hope that sort of, well, sometimes you do, but hopefully you don't sort of find stuff that rises to the level of killing the deal. But, you know, the ones, I suppose, but then I think you will try to structure for it, and the issues come if you can't then reach an agreement on it. That's where you will find deals fall down. So, you know, like I said, you don't have the IP in place that you need, or you've presented the transaction, but you haven't got your accounts properly in order. So actually the numbers that this was all based on at the beginning fall apart the moment they're put through financial diligence. That's probably the, you know, the biggest one is on the commercial side. But then also regulatory compliance, right? You face the brand and actually dig into it. And this is a problem in the space, particularly around, things that are regulated, whether it's cosmetics or, food supplements or things like that, where, people haven't sort of yet, or you've got founders who haven't sort of appreciated perhaps all the regulatory implications of that. So when you get into it, you realize there are things there. I'd say those are kind of the main ones, but you obviously, we want to do these transactions. So, you always try and find a route to tackle these problems in diligence. Most of the time you can get there, some of the time you can't.
Yeah, thank you very much. Okay, let's move on to topic 2, which is probably one of the most important topics for sellers, the upfront component of compensation. Again, if we can start with Chris and Nathan to set the scene from the seller side, and then we'll ask Sean to discuss the buyer side. Thank you.
Sure. Nathan, you want to jump in?
Yeah, let's go for it. So yeah, upfront compensation is super important for all sellers. It's the number that they see, it's the number that they rely upon, and I guess ultimately, if it's not the right number for them, it's often not the right deal for them. So getting clarity on the quantum of that in the LOI is obviously very critical. But also as well, where we see, I guess, some misunderstanding when you get to long form is the TTM. So it's super helpful in LOIs when the measurement period, I guess, for the upfront compensation is clearly recognised, or indeed where that's still fluid, that it's recognised that it's actually just going to be pegged to, I guess, a date closer to closing. Again, this comment about SDE versus EBITDA and how it may affect upfront compensation. Again, yeah, just making it certain in terms of the metric which is being used and the multiplier which is being attached to that metric. What else have we got on this slide? So in terms of the comments from me, yeah, I guess the last point is just something which I've been sort of evolved across primarily the European aggregators actually. Initially, all sort of balance sheet adjustments were all done by completion accounts, but then you start to see the introduction of people preferring to settle price on the basis of lockbox. But I've seen some contracts where actually that wasn't necessarily discussed at LOI, but then when you open up the long form, you sort of see it being done in a slightly different way. So, either works, but it creates better certainty and a more efficient process if those sorts of things could be penned and agreed in the term sheet.
Yeah, and likewise, I echo what Nathan just said there on the seller side. I would also stress, to Richard's point on the last slide, the notion about being transaction ready, because sellers are often going to just hone in on this upfront payment. That's the most, typically the most exciting part for them. But being transactional ready helps make sure that the timeline is going to stay on par, which can also bleed into the comment Nathan made about TTM. We've represented sellers that the deal just drags on. We've gotten past the LOI stage, we're in the APA stage or the share purchase stage, we're negotiating back and forth. Buyer's still doing a little bit of diligence, and then there's some questions about numbers and finances, and now we're kind of trying to figure out, are we looking back to trailing 12 months from when we signed the deal? Do we have to look at back when we kind of first started negotiating? Things can happen with the business, just by the nature of the business, that can kind of negatively or positively impact kind of what's going on. So all of that kind of goes into just making sure that, yeah, this is the number that it is today, and to Richard's point, we don't see buyers kind of going backwards on that, but it is a matter of just making sure the sellers are aware of the terms of the upfront consideration. And I always stress too that they kind of do their own homework, or at least seek advisors and counsel that maybe have a finger on the pulse with what typical multipliers are, considering their business and their industry, and making sure that the LOI is also going to be in line with those parameters as well. And absolutely, if the number doesn't appear to be right, then wholeheartedly echo Nathan's point that this just probably isn't the deal for them at this time. And this is a good stepping away point too, which is, something we don't like to talk about. We always want to see these deals go through, especially for buyer and seller, but this is a big piece of it for seller, and they need to make sure that this is the right exit for them.
Thank you, Chris and Nathan. Sean?
Thanks, Emmett. Well, I think the good news is that Chris, Nathan, and I kind of generally agree on like a lot of the same issues here. And then this really is, one of the most important points. And I think I'd say on kind of the first bullet about, all cash versus kind of some cash versus deferred, it's really about how the seller kind of views the business. They're looking for in kind of what they want to do personally. They're looking for a quick exit, kind of head to the beach or vacation or what, or do they want to kind of participate meaningfully and the kind of upside and the kind of partnership with this new platform that they've partnered with. And so that's, I think, from a seller's perspective, how you should think about this. I know at Branded, and I'm sure a lot of the other aggregators here, we view the partnership and the kind of potential to grow the business as a meaningful part of the deal. And we look to structure most of our deals with, a not immaterial component of kind of deferred compensation, which some of the folks on the line will get into later. I think just kind of speaking about that, to the extent you do want all cash, it's not a linear value, right? All cash up front may reduce the overall value, but the trade-off is increased certainty of some certain kind of at closing. So that's the kind of, things you're thinking about from a sell side perspective. Similar point on cash versus equity. It's again, kind of quick exit versus kind of meaningful participation on the equity end versus just, kind of a deferred payment. You're actually going to participate in the kind of platform's overall success. So if you believe in kind of Branded or Acquco or unybrands as kind of an entity, kind of participate meaningfully as a stakeholder in that entity. And you'll see this a lot where the founder or employees kind of participate either consulting or kind of meaningful, ongoing operations of the business. At least that's kind of how we view that at Branded. And then kind of on the multiple, revenue, SD, EBITDA based, kind of similar concepts to what Chris and Nathan talked about. You certainly want the correct, trailing 12-month multiple. The idea is seasonality of the business. Obviously Q4 is kind of gangbusters in a lot of retail, particularly e-commerce. But you use a trailing 12 months to kind of, meld, kind of blend, seasonalities of revenue and things like that. But you want to get it, typically as close to the transaction as possible to give an accurate snapshot of the earnings of the business. And there's some, technical differences between EBITDA and SDE, but I don't think we need to get into the nitty gritty on the call unless people are curious about that. An important point, I think also, on the timing point, sometimes sellers will get into these transactions and they'll sign up a deal and they'll see several $1 million, coming to them. And they'll think, great, I get this at close. But, as I'm sure a lot of people on this phone know, there are a lot of intricacies involved with migrating accounts, transitioning inventory, that sort of thing. So not infrequently, there will be structures built in, at least I put them into LOIs at the outset so people are aware, where you'll kind of hold cash in escrows. Buyer will fund at close, but seller won't receive the cash, upon a completed migration. And I think the thing to think about there is kind of what qualifies as a completed migration, kind of what is mission critical to operate the business versus maybe something more akin to a transition service to kind of keep things going. And then kind of inventory point, how much is included in the upfront payment, reviewing it as a separate payment, or is from the buy side, are you viewing this more as the purchase of an ongoing, business where kind of a normalized level of inventory would be expected to be included. So do that.
Excellent. Thank you, Sean. We have some questions, but we'll keep going and get to those at the end. Again, please do submit any questions you have via the Q&A function on Zoom. Thank you, Sean. Okay, so let's go to topic 3, the deferred component of compensation. Again, Nathan, Chris, please help set the scene.
Sure. I think this dovetails kind of nicely into what Sean was just saying, about the different structures here with the holdbacks, or how the payments are ultimately going to go. Sellers from the seller side, our concern is largely aligning on what metrics are going to be used when we're determining, any kind of deferred compensation. So if it's the stability payment, what are we looking at as far as baseline revenue or baseline SDE? What's the applicable time, frame for this? And I think it's appropriate at the LOI stage to have conversations about what potentially is on the table in terms of limiting the buyer's control a little bit in terms of the way they run the business. It's a risk that the seller is taking when they, agree to accept some stability payments, because they're going to take it on good faith that the buyer is going to be able to grow the business. But at the same time, a lot of what they're, riding on in terms of this deferred compensation is also going to, hinge on that, and operating the business in, a way that's not going to, they're not going to just ramp up, expenses. Not that really, that's going to happen, but I think the conversation is worth having as far as what degree, is a buyer going to come in there and start pulling levers, and how comfortable a seller is in accepting stability payments that are maybe hinged on increased growth in a certain metric like revenue or SDE. And yeah, obviously, the other terms of any, holdbacks, is there a timing provision? Mainly just being clear on the roadmap that's going to lead to this deferred compensation is pretty critical for the sellers.
Thanks, Chris. Nathan, anything to add there?
Yeah, just from my side, I think the transactions that I see move most efficiently and smoothly are probably the ones that invest a bit more time at LOI stage, really drilling into what makes up EBITDA and SDE, to avoid those sort of conversations about what's in and what's out when it comes to long form between sort of in-house accountants and investment bankers at the aggregator, and CF and accountants on the sell side. So if the parties can sort of work towards an agreement on the definition and makeup of SDE for the purposes of deferred compensation, I think that's time well spent during the LOI. And I guess the main disconnect that we do see is around OPEX, because an OPEX of a seller pre-close is going to look very different to an OPEX of an aggregator post-acquisition. So finding solutions to that that works for both sides can often save a lot of time on the back end. Mm-hmm. And then I just think the final point, just in relation to holdbacks, there's a big cultural difference between the application of holdbacks across the US and the UK. Sometimes when there's not reference to holdbacks in an LOI, when you're dealing with a US counterparty, you do often find there is a holdback when it comes to long form, and that can create some tension. That's not so much the case these days, but during the genesis of the space, that used to happen quite frequently, particularly amongst PE and strategic buyers. But I think just so everybody knows exactly where they stand, I guess certainty around time, quantum of holdback, whether it's for indemnification or whether it's for sort of working capital true-ups, or whether they're combined or whether they're separate, is time well spent between the parties, if indeed there is a holdback that's agreed.
Agreed. Thank you, Nathan. Chris. Wolfgang.
Yeah, thanks. I also agree. And we at BBG, we believe that a letter of intent should give the seller full transparency on the terms of our offer. And although I listed all the components of deferred payments that came up to my mind or I've seen in the market, I think at least depending on the deal structure, not all of them are always necessary. We at BBG, we usually prefer to structure the deal as an asset deal, which has, from our point of view, the advantage for the seller that it is less complex and the risk can be hedged better. We therefore can offer a very simple payment structure consisting of upfront payment and earnout, and usually don't use none of the other deferred payment components I've listed here. So we believe that a well-structured and transparent LOI should state the multiple SDE multiple for the total purchase price, as well as the SDE multiple for the upfront payment, to make the offer more comparable for the seller. And with regard to the earn-up component, where we measure earn-out fairly at margin contribution level, as Christopher also mentioned. It's always, from our point of view, worth and useful to define and to discuss at what level the earnout payments will be measured. We would define margin contribution level as revenue minus costs, and define costs as those attributable to the fulfillment of a customer's order of the product, which would include cost of goods sold, fixed and variable cost, but exclude overhead cost. We basically recognize there that our cost structure differs from that of the acquired business, and we believe it is unfair to consider our total costs when determining a product-related earnout. Different to other earnout calculation we have seen in the market, we share profits from the very first euro earned at contribution margin and do not share additional profits only or at EBITDA level only, where all costs are taken into account. In our letter of intent, we also indicate the fixed percentage of the annual share and contribution margin, as well as the underlying assumption of the key valuation matrix. So as I said, basically trying to give full transparency. I also made the same experience as Nathan did. Very important to have the deal terms clear in the letter of intent, and you have less discussion in the end and a smooth transaction normally.
Very good. Thank you, Wolfgang. So we've looked at upfront compensation, deferred compensation, but there are other forms of compensation, some known widely, but some more obscure. So I'd like to invite Philipp from Stryze, Nathan and Christian to discuss some of those. Maybe in this case, I'll start with Philipp to give some context on his thoughts.
Yes, thank you, Emmett. I think other compensation has some creativity attached to it. It really depends on the particular deal situation and also what the needs are of the particular seller. It could really change from situation to situation, but generally, I think it's fair to say that it's a good way to bridge price expectations between buyers and sellers beyond the typical transaction structures as upfront and deferred payment mechanics that we learned about earlier. It's also good to enhance the alignment of interest between buyer and seller. And if that's of mutual interest, it's also a good mechanic to negotiate and structure a long-term cooperation between the seller and buyer. I think generally it's very much structuring the post-transaction environment in most cases. And I've tried to group certain mechanics into subgroups. Let's just jump right into it. First one is financial compensation and benefits, where you can clearly measure economically and financially what the benefits are. I think one of the more obvious ones is an employment with the buyer or aggregator after the transaction. It could be something like you continue working on the brand that you sold. It could be that you'll be working on other brands as well, or for example, if a certain or your brand that you sold is a starting point for the aggregator in a certain product niche, so to speak, it's a nucleus. You could be involved in adding certain adjacent product categories in that and working on the further development of these products. And in terms of compensation, that would mean you get your base salary plus performance-based compensation, could be ESOPs, could be bonus payments, profit shares, whatever really. And based on what we often hear from sellers is that they actually like about the Amazon FBA business that they can develop new products, be creative, do marketing, etc. And they do not very much like the, let's say, fighting with Amazon, handling the numbers, accounting, and all that. And the second concept, product development compensation, kind of adheres to that, because we would give the seller the option after some time of transition period in which the seller could actually develop and launch new products to benefit from the positive effects in terms of a profit share. Let's say the seller stays on board for a year, and in that year, the seller develops, I don't know, 10 new products. The seller would be entitled to a certain percentage of the new products, the profits of the new product after that 1 year period. So that would be a nice kicker as well. Consulting arrangement, that's something that we implement relatively often. That's really applicable for the post-transition period time frame. Once the business has been handed over to the buyer. Normally that's an hourly rate that the seller would receive from the buyer. Probably more relevant if the seller has a certain skill set that's very relevant for the buyer. For example, the buyer has, I don't know, implemented a new product that needs to be produced, and the seller has a very good relationship to the supplier. That could be useful, and the aggregator could draw upon this expertise. Then what we also see often and have very often implemented with former sellers is a referral arrangement, or also known as a finder's fee arrangement. Many of the Amazon sellers are very well connected in the Amazon space. So if they make any introductions to us or any other aggregator, and we do a deal with the introduction potential seller, the former seller could actually earn money based on that and receive a certain fee. The scale of that arrangement really depends on what the seller makes out of it. Some really see that as an opportunistic business opportunity. Some make introductions on a weekly basis. It really depends on what you make out of this. What I also see here now is that the option to reinvest some of the proceeds, to be honest, I don't see that often, because for most sellers, the Amazon business is very capital intense. They constantly inject money into the business to keep it growing. And I think it's fair to say it's a cluster risk, and they are more keen to actually take money off the table and put it somewhere else instead of reinvesting. But I'm inclined to hear what your thoughts on that is later. Rollover of shares, I think that kind of alludes to the same thing. It also has some complexities, I would say, in terms of structuring. The same, in particular, when you do asset deals, probably more easier to implement than share deals. But hypothetically, if you sell like a 60% stake in your limited company and retain a 40%, you would be entitled to profits. 40% of the profits would be in your pocket, and you could probably benefit from the exit of the 40% at a later date. In terms of contractual documentation, I think it also has some complexity. As I mentioned, you probably need a shareholder arrangement. You need to have a put-call option structure, good lever, bad lever, governance, etc., veto rights, you name it. I think it's fair to say that most of the transactions are 100% sales, but also very much looking forward to your view on that.
Philipp, I'll just jump in. Maybe Nathan, do you want to take the next two bullet points, and then we'll go back to Philipp?
Please.
Yeah, where did we end up? Sorry, was it on?
We're on receive phantom equity, I think was your point.
Yeah, so actually this sort of emanated from mid-market PE in the US, who was hoovering up e-com businesses. One of their limbs of compensation which they were offering sellers was a kicker based upon the contribution margin of the target to that particular buyer at the time of the sale of that buyer, whether that be via listing or indeed some other form of exit. And I have actually seen that term sort of move over into one of the European aggregators as well. And one of the sellers we closed a transaction in December actually who had a similar right to that. It looks great for the aggregator because when you've got a highly competitive asset, it's a big differentiator. And for a seller, although there's no real basis for this yet, I would say, the multiples which are attached to that particular line of compensation can look very punchy relative to that which is attaches to the upfront compensation and deferred compensation. So yeah, I think it's just a quirk which has come about from other markets, seen it in lots of other markets and lots of other deals, but it's something which I've seen on e-com deals as well. And then, yeah, just something else which we're seeing in the space is aggregators offering the opportunity for sellers to retain a minority interest and then doing a joint venture with the sellers. So the aggregators really looking to benefit from the operating experience and the entrepreneurship of the sellers, and I guess give them the working capital comfort to be able to build out the brand and then ultimately sell the remaining interest at the same time as when they sell themselves, or indeed at a fixed point in time in the future via some form of put and call option. So yeah, those are two limbs which are seen not frequently, but it's a line of compensation which is for one particular aggregator. But then I know that there's some in the UK and Europe that are looking at doing joint ventures more frequently as well.
Thank you, Nathan. Philip, we have 1 minute left for this slide, so please go quickly to the next points.
Yeah, then let's quickly touch upon the non-financial compensation and benefits. I tend to compare it with a labor contract or employment contract, where you negotiate perks and benefits. PR and publicity might be very relevant. For example, if a former seller is looking to start his new venture, what we often see also as Stryze Group is that we showcase the exit on LinkedIn and in newsletters. That could be a good thing if you want to start a new business and have some reputation in the market already. Then at Stryze Group, for example, we have lots of training opportunities, could be public speaking, could be negotiation tactics, could be writing business plans, you name it. And that could be a good option for you to, as a seller, to participate in these training sessions, which we regularly do. And then most aggregators, I think it's fair to say, are backed by renowned investors, entrepreneurs, etc. The seller could probably make use of that network. Thanks.
Excellent. Excellent. Thank you. Let's move to the final topic, which is other key points of the LOI. So we started off thinking about the goals of the LOI. We spent a lot of time thinking about the compensation, but we wouldn't be doing justice to the LOI if we didn't talk about lots of other key points. So can I ask Chris and Nathan to kick off here, please?
Sure. Yeah, I'll jump back in here. Some of this has already been touched on a little bit, but obviously, we want to make sure that the sellers understand the exclusivity period and what that's going to entail, and make sure that that's reasonable, for them, and discuss maybe some of the underlying complexities of the transaction. And again, to Nathan's point earlier in the outset here, on hammering out any of these other material terms aside from just payment, the upfront compensation, the deferred compensation. I think this is another good point, just to jump back over to the other compensation slide, to handle any kind of other compensation and to understand certain of the complexities with that. The benefit of the other compensation is you can use more creative forms of compensation, perhaps to reach a number on the seller side that the buyer just simply isn't able to meet them on an upfront or deferred compensation side. But they need to know kind of what the ins and outs of that are. I mean, we discussed a little bit of phantom equity, a little bit of receiving a minority stake, a bit of a planned exit whenever the aggregator maybe goes to sell the asset or undergoes an IPO. But carving out these material things now here as well, so that there's not a surprise later once we're at like an APA stage and now we're trying to discuss what the terms of this phantom equity are, and that becomes just really muddy and it can just delay the deal. You might as well just get these conversations out now versus having these conversations later, because it'll just delay things.
Understood. Thank you, Chris. Nathan, anything to add?
Just on the last bullet, I guess. And this is not so much the case now, but yeah, when we first started doing deals in the space in 2019, one of the things which was really heavily negotiated on the LOI was the governing law for the acquisition agreement. And I think it's primarily because the market just was created in the US, and there was lots of people in the US who had never really cut a deal over in the UK and were very sensitive about actually contracting on the basis of English law. But with the asset deals, it sort of works. But with the share deals, where the clients were agreeing to some form of US law, it works, but you sort of end up with this hybrid acquisition agreement spanning 2 jurisdictions and dual counsel from both sides of the pond. So it was just very messy, made transactions very long, and frankly made it expensive for both sides. But I think there's just a general recognition now across the market that speaking specifically for England, that if you sort of deal making in this country, that you sort of follow general principles of M&A in that respect, in that, you know, the governing law should really be the governing law of where the target's domiciled. It just makes the whole transaction run a bit easier from my perspective. So that's probably the only other point. It's sort of moved quite a bit since the genesis of the market, but it used to often be something which was quite heavily negotiated.
Thanks, Nathan. Chris, over to you, please, Andrew.
Yeah, sure. So I think, as Chris just mentioned, a lot of this has been touched on a little bit, but maybe I can kind of talk about some things in a different light. And when you talk about agreements with management and employees, I think that's another example of somewhere where the buyer and seller aren't necessarily opposed. So that's just something we like to talk about at the LOI stage to make sure both parties are aligned and have a meeting of the minds. And we interact with sellers that just have totally different expectations. So we've done acqui-hires where we have former sellers that are in our leadership team now. And then we've worked with sellers that are planning to, go to Costa Rica and retire on a beach. And, something in the middle, someone that's really entrepreneurial and they're taking the money and they're starting something new, and we're still in touch with them and, looking forward to doing another deal with them again. So that's something where, at the LOI stage, we're really just, feeling the seller out and understanding their preferences and, what their expectations are and what their plans are after we consummate the transaction. And then I guess to talk a little bit about exclusivity and to lean in on something that's come up a few times, and transaction readiness. So, one thing that's important for the buyer in locking in exclusivity is, as soon as we sign the LOI and we have exclusivity and the expectation is that we're proceeding to a deal together, there are a ton of people internally at Acquco and externally professional advisors that, go to work and really get under the hood of the business. So there was a question I saw about, would an aggregator, pursue an exclusivity breach? So, something we'll put in an LOI is that if there is an exclusivity breach, we would expect to be reimbursed for those expenses. We hire external accountants to sometimes put together a P&L or vet an existing P&L. And then, of course, there's the legal expenses of the documents and all of the different checks that we have to do during due diligence. And then I guess the other thing we talk about at the LOI stage is the non-compete, the scope and the length of the restricted period. So the scope, often kind of goes hand in hand what I was talking about. What type of seller are we dealing with? Of course, we need our protections. We're buying a brand that we're really excited about, and you've built something great. So we certainly don't want to acquire a brand and then have you start something exactly the same thing and work with the suppliers you have such a great relationship with and then directly compete with us. But we're happy to find something where you can build something great and be a repeat customer. And the length of that non-compete varies from deal to deal. I guess I just put out there that the buyer's perspective when thinking about how long it is that often the non-compete period itself is still going to be shorter than the EBITDA, the number of years of EBITDA you're getting up front. And really with exclusivity or with the non-compete, we generally try to leave it a little bit vague in the LOI and kind of agree later based on a framework we set forth, because there's going to be a lot we're going to learn in due diligence.
Yeah. Excellent. Thank you, Andrew. Okay, we have about 5 minutes left. We're going to have a quick fire question approach here, where we'll sort of try and cap the answer at 30 seconds. So we'll ask all the speakers to be as succinct as possible and just really get to the nub of the question. So first question, would you consider contractual penalties for exclusivity as market standard, or do you see a lot of deals without such penalties in term sheets? Whoever would like to answer that, please jump forward and be succinct as possible.
Well, I can speak for BBG. We don't have penalties in our term sheets or LOIs.
Yeah, I haven't really seen any, penalties as far as the, exclusivity or what's going to be the consequence of, breaking that. But I think Richard hit on it earlier on. It speaks more to professionalism and the just general working relationship. It's kind of like just an underlying implied working relationship and mutual respect for each other.
I'd echo that. We don't have penalties, but I think, it's the point you made around how long it takes, how long you spend on the deal. If you turn around the day after and say, I've had a better offer, we will shake hands and move on. But if we just spent, 6 weeks spending a lot of money on people and having our team work really hard, we'll take it. And then you decide at the last hour you've got a different offer, we'll probably take a different view.
Yeah, fair. Do any aggregators actually ever sue sellers for breaches of reps and warranties, as this would be bad for the aggregator's reputation to future sellers? Interesting question.
At least at PBG, it hasn't happened so far. So we had no breaches of reps and warranties. But yeah, with regard to our deal structure of other deals, we see only a few risks that have to be hedged with reps and warranties.
We've never done it either, and I think as the question alludes, we're not in the business of suing the seller community. It's not really what we want to do. But again, I think it's a facts and circumstance. I think it goes to how egregious you are. If you've been outright lied to and you've now got a worthless asset or one that's just significantly worse, then of course we'll take action, right? So it depends on the circumstance.
Yeah. Very good.
Stryze either.
Okay. New question. How often do you include warranty liability limitations in the LOI? And in the US, are warranties given on an indemnity basis?
I think I'll jump in of the two kind of US aggregators. So yeah, their reps and warranties in the US deal are usually subject to kind of a US style indemnity. Being to the extent they're breached to a certain degree, they're untrue and we incur a loss, and the kind of definition of loss associated. In terms of the cap, yes, certain kind of prongs of that indemnity subject to fairly market standard, practice are capped at either purchase price. Some things if there's outright fraud are uncapped, certain things we incur like tax liabilities, which are like rightfully, generally speaking, stay with seller. They'd be uncapped or dollar for dollar, but a lot of times they'll be capped at some percentage that is under the purchase price.
Thank you, Sean. Can someone give one or two examples of holdbacks?
Holdbacks? Yeah, so I mean, we had a situation in one transaction where actually it was a regulatory point. So the seller hadn't done various of the things they needed to do to get a couple of products they were selling approved. There was a regulatory approval, they needed to have that. So we held back the bid of the purchase price that you'd allocate to those ASINs until the regulatory approval was in place.
I see this a lot with inventory. We do a lot of work in the cosmetic space, and to the extent the various cosmetics haven't met various regulatory regimes, we'll hold back or put in escrow the portion of the price for that, pending the testing, and we'll pay for ones that pass, for ones that don't pass. It's kind of straightforward.
Yeah, and we've seen it a little bit on intellectual property as well. If there's maybe some C&Ds they've received or something, it seems like maybe there's an issue. It's often a conversation that like a buyer may ask for a holdback just on the basis of like this looming issue, but they still kind of want to go through the transaction. It's a risk assessment and it's kind of fact and circumstance heavy, but that's another example as well.
We've seen this in the context of account migration. Once that's complete, the full purchase price will be paid.
Excellent. Thank you all speakers for your time. To Nathan, Chris, Andrew, Sean, Philipp, Richard, and Wolfgang, star-studded set of speakers today. Thank you all for contributing to the topic. As a reminder, the recording of this webinar will be made available to everyone that's attended and to those who registered who couldn't attend, and will be available on our website over the next few days. So clearly, there's a lot to discuss. There's a lot to think about when one looks at LOIs. Some people think it's a very simple document that's non-binding, very simple, but to get it right, there's a lot of thought needed. And I think one of the key terms from today is the more transaction ready or exit ready the sellers are, the better prepared, the better and more seamless the deal will be. So please reach out to myself or any one of the speakers to gear up and prepare properly for deals down the line. Thank you all and have a great day. Take care. Bye-bye.
Thank you. Bye-bye.
Thanks, everyone.